I've been staring at the same set of candles for 3 days straight, and I'm telling you right now, something is off. Not maybe, not it could be, not I'm probably overthinking it. Off. The kind of off that makes your stomach tighten when you realize the story everyone is repeating can't possibly be the whole story. At first I thought I was just tired. You know that feeling when you've been chart watching too long and your brain starts connecting dots that aren't there? So I did what you're supposed to do. I pulled the data again. Then I pulled it from a different source, then another. Then I compared time zones, checked after-hours prints, checked futures versus spot, checked the ETF versus the underlying, checked the miners, checked volume, checked everything a sane person checks before saying something publicly. The numbers didn't change. And the more I looked, the more disturbed I got, because if what I'm seeing is real, it changes the way you should interpret Friday's crash completely. Let's talk about the thing everyone already knows. Silver got obliterated, a 39% collapse from the peak in one session. Modern history type move. The kind of move that doesn't just hurt portfolios, it snaps narratives in half. It triggers forced selling, margin calls, liquidation cascades, the whole chain reaction. And that's exactly how it was reported. Silver crashed. Retail destroyed. Trillions wiped. Bloodbath. Wipeout. Historic. Every analyst clip, every headline, every short-form finance video screamed the same message. Silver got annihilated. But here's what nobody is showing you. Or maybe they're showing it and not noticing it. Or maybe they're noticing it and not saying it. Either way, this is the part that kept me awake, because it doesn't fit the script. I pulled up SCL, the silver miners ETF. Not the metal, the miners. The companies with drills, permits, payrolls, power bills, equipment leases, debt covenants, and entire business models tied to digging metal out of the ground. These aren't memes. These are real operations with real costs and real revenue sensitivity to commodity prices. And that's where it gets weird. Miners usually move more than the metal, always have. That leverage is basically a law of nature in this corner of the market. When silver rises, the cash flows of miners can explode because many costs are fixed, while revenue rises with the commodity. When silver falls, the opposite happens. Margins compress, earnings get wrecked, balance sheets get questioned, and the equities typically get hit harder than the metal itself. In big moves, miners tend to exaggerate the move. This relationship has held across cycles for decades. It's one of the most reliable behaviors in commodities. So tell me how this makes sense. Silver drops 39% from its peak in the most violent single-day move people can remember, and SIL drops only 22%. Read that again. A historic collapse in the underlying, and the levered expression barely plays along. If you've traded commodities or miners, you already know why that's unsettling. If the market truly believed silver's price action was real, miners should have been obliterated, not down 20-something, down 60, down 70, down 80. That's what the whole business model just got punched in the mouth looks like in equities. Instead, the miners acted contained, like someone, somewhere, decided they were not going to dump them, like hands that normally panic, didn't. I sat there with that chart open for hours, asking myself one question. What would have to be true for the miners to refuse to collapse while the paper price of silver is falling down an elevator shaft? There are a few possibilities. Maybe the miners were undervalued going into the event, and the silver spike was a blow-off that wasn't fully priced into equities. Maybe SIL's composition includes diversified miners with byproduct credits, so they're not pure silver plays. Maybe there was a technical factor. Maybe options flows pinned something. Maybe the ETF mechanics created a temporary illusion. All of that is possible. I'm not dismissing it. But none of those explanations fully accounts for the magnitude and timing of this divergence. Because the divergence wasn't subtle, it was loud. And then another thought hit me, and I hated how much sense it made. What if the people with the biggest positions didn't believe the crash was real? Think about how markets actually move in a liquidation event. Retail isn't setting the price at the bottom of a waterfall. Forced selling does. Leverage does. System rules do. The market doesn't ask if you want to sell when margin calls arrive. It sells you. It turns your position into a number in an algorithm, and then that algorithm becomes your execution. That's how retail gets destroyed in crashes. Not because everyone simultaneously changes their mind, but because the system forces the weakest hands to hand over assets at the worst possible moment. Now ask yourself, if silver is collapsing 39% and miners are only down at 22%, who held the line? Who didn't slam the sell button? Who didn't puke their positions? It's hard to escape the implication that the biggest money, the hands that can actually absorb volatility without being forced out, didn't run. And if they didn't run, you have to ask why. Because the obvious reaction to a commodity crash is to assume the narrative turned, the cycle broke, the price is repricing lower, and the equities tied to it should be dumped before earnings get revised down. That's how normal fear works. So why wasn't normal fear reflected in the miners? There's one explanation that fits cleanly. The crash was a paper event, and the bigger players expected it to mean revert, so they didn't treat it like a fundamental repricing. And if that's true, then the next question is unavoidable. If smart money expected it, did someone engineer it? Now, before someone clips this and screams conspiracy, let's get something straight. Markets can be manipulated. That is not a controversial statement. It's documented, it's prosecuted, it's in public records. We can debate how often it happens and in what form, but the fact that it can happen is not up for debate. The only question is whether this specific event shows fingerprints. So I went looking for fingerprints. I started with the timeline, because timing is where intent hides. Over a tight 72-hour window, Tuesday to Friday, the market was fed two signals that pointed in opposite directions, and the reversal was timed for maximum damage. On Tuesday, the signal was interpreted as weak dollar policy. Weak dollar usually means strong precious metals. The trade was obvious. You didn't need a PhD. You didn't need a quant team. If you're a macro trader, your brain is trained to see that and press the same button you've pressed 100 times before. Funds pile in, retail piles in, sure thing, energy spreads. People start talking numbers that feel ridiculous until they feel inevitable. That's how euphoria builds. By Thursday night, silver is screaming into an all-time high near $121. And you know what comes next in that kind of environment. The stories, the fantasies, the $200 silver threads, the "this time is different" claims, the early retirement calculations. It becomes a social event. It becomes a tribe. And when a trade becomes a tribe, the trap gets easier to set. Then Friday morning, before the cash market even has a chance to properly breathe, the signal flips. Suddenly, it's a strong dollar hawk narrative. A Fed chair style announcement drops into the tape at the worst possible time. The kind of timing that doesn't just surprise markets, it forces repositioning. The people who shorted the dollar now have to buy it back. The people who bought metals now have to sell. The people on leverage don't get a choice. This is the moment the crowd learns the difference between conviction and margin, and then the cascade starts. The part most people don't understand is that once forced liquidation begins, it becomes self-feeding. Price falls, margin calls increase, forced selling hits, price falls more stops trigger, more forced selling hits. It's not a debate, it's gravity. You can have the best thesis in the world, and it won't matter if your broker is closing you out at market. So yes, silver collapsed. And yes, retail got hit. That's the visible part. But I wanted to know what was happening behind the curtain, where big players operate. Futures positioning, delivery data, clearing mechanics, and exchange rule changes. That's where you find the machinery. And that's when I pulled up something most people never look at. The COMEX delivery report for January 30th, 2026, the day of the crash. This is not some secret leak. It's published by the exchange. It's public. It's boring looking. It's the kind of document that doesn't go viral because it's not designed to. But boring documents often tell the most explosive stories because they're written for compliance, not for impressions. In that report, there's a column that matters. Stopped. In futures language, stopped relates to contracts that are being taken off, positions being closed, delivery-related actions being recorded. This is where you can sometimes see who is active at critical moments. And then I saw a line that made my jaw tighten. JP Morgan Securities stopped 147 contracts on the exact day of the crash. Now let's keep this grounded. One line item doesn't prove a grand plot by itself. Markets are complex. Big firms do many things at once. They hedge, they roll, they arbitrage, they warehouse risk, they act for clients, they act for themselves. So I'm not saying one number equals guilt. What I'm saying is, when you see a historically violent move and you see the same familiar names acting in a way that looks like perfect timing, you don't shrug and move on. You dig. Because here's the question. If you were short silver and the metal just collapsed 39%, that day is payday. And if you can close near the bottom, you maximize payoff. If you close too early, you leave money on the table. If you close too late, you risk the bounce. So how does a firm consistently have the ability to close at the right time in the most chaotic environment imaginable? You can call it skill, you can call it luck, you can call it sophisticated risk management. But if the same names show up again and again at the same kinds of turning points in the same kinds of markets, at some point luck stops being a satisfying explanation. And it wasn't just one name. Other major banks appeared in that same orbit, the same categories of players, the same institutions that have historically been involved in enforcement actions in precious metals markets. That's where the word most people don't want to hear comes in: spoofing. Spoofing is a type of manipulation where a trader places large orders they don't intend to execute. to create the illusion of supply or demand and push price in a direction that benefits them. The goal isn't to buy or sell that giant order. The goal is to make everyone else react to it. It's theater, designed to trigger real behavior. If you can make the crowd believe a massive sell wall is about to hit, you can trigger panic. If you can trigger panic, you can buy cheaper. And if you can do it with enough speed and enough size, you can move the market without really moving it, because the crowd moves it for you. That's why it's illegal. That's why it's fraud. And that's why there have been actual prosecutions in precious metals involving major banks. Not rumors, not internet drama, public cases, fines, guilty pleas, and prison sentences for specific individuals. This is documented reality. Manipulation has happened in these markets. Now here's the part that matters for your interpretation of Friday. Ask yourself a brutally simple question. Do you believe a system that has been caught cheating before is structurally incapable of cheating again? People love to believe enforcement means reform. But enforcement often means you got too visible. Fines become business expenses. Risk becomes a line item. Compliance becomes a department that exists to manage optics, not necessarily to eliminate incentives. And the incentives are obvious. In a leveraged paper market, if you can push price far enough, long positions get forced out. Forced selling is the cleanest fuel there is. It is automatic. It doesn't negotiate. And when forced selling hits, whoever is positioned on the other side gets paid. So I kept digging. And then something else happened that made the whole thing feel less like a crash and more like a procedure. CME margin requirements. Margins are the cash you must keep in your account to hold a futures position. They're supposed to manage risk. In theory, if volatility rises, margins rise to ensure participants can handle swings without defaulting. That's the official story. But the timing of margin changes matters as much as the changes themselves. If an exchange's primary goal is to reduce risk and prevent a blow-up, the most logical time to tighten leverage is before volatility peaks, when the market is frothy and extended. Raise requirements when things are overheated, and you cool speculation before it becomes unstable. That's how you prevent a cascade. And what happened here didn't look like that. Margins were hiked after the crash, then again almost immediately, with more hikes signaled right after. A sharp jump, the kind that forces participants to come up with more cash fast, or get liquidated. And when you force liquidations, you create more selling pressure. You don't calm volatility, you can amplify it in the short term, so why do it? There's an uncomfortable explanation. Because someone big is in trouble, and the system is protecting itself from a clearing failure. This is how stress moves through leveraged markets. It's not about one trader losing money. It's about whether the losses can be settled. If a major participant can't meet obligations, the risk spreads into the clearinghouse, then into everyone connected to it. That's when exchanges become aggressive, because their job isn't to protect your account. It's to protect the integrity of settlement. So when you see emergency-style margin hikes stacked on top of a liquidation event, it can be a sign that the exchange is not trying to help traders. It's trying to make sure the system survives. And if that's what's happening, it changes the interpretation again. Because then the crash isn't just sentiment shifting, it's the system forcing positions out to prevent a bigger failure. Now step back and look at the historical pattern people keep pretending is random. In 1980, silver ran from roughly $6 to $50. Massive move, mass attention, mass speculation. Then rules changed. Leverage got constrained. The market broke. Silver collapsed. In 2011, silver ran from single digits to around $50 again, and then margins were raised repeatedly over a short window. The move reversed violently, silver got cut in half. And now here we are again. Silver ran hard, attention exploded, leverage piled in, euphoria peaked, and then the market got hit with a sequence of events that produced maximum forced selling. I'm not asking you to believe in villains twirling mustaches. I'm asking you to notice the repeating mechanics. When silver goes parabolic and public participation surges, the pressure points that control leverage and settlement suddenly become the center of the story, and the end result is the same, a violent flush that transfers assets from weak hands to strong hands. And that brings us back to the miners. If the miners didn't collapse the way the metal did, it suggests that the equity holders, the deeper pocketed money, the longer duration money, did not treat Friday as a permanent repricing. They treated it like a shakeout, like a paper liquidation, like something that hurts the leveraged crowd but doesn't change the long-term game. Now let's talk about the part that's even more important than charts, physical. Because you can argue paper price all day, but physical availability is harder to fake in the moment. After Friday's smash, premiums reportedly blew out. Dealers weren't selling at spot. They were selling at spot plus a painful surcharge, or they weren't selling at all. In situations like this, the paper market can say one thing while the physical market screams another. That's not mystical. It's supply chain reality. If you can't source metal at the paper price, the real price becomes whatever clears actual inventory. And then came the kind of signal that makes professionals stop joking. A major mint reportedly paused sales because they couldn't secure supply at scale. Think about what that implies, even if you assume it's temporary. If silver were truly abundant at the new lower paper price, the supply chain would loosen. Sellers would appear, inventory would flow. But when availability tightens right after a paper crash, when the crowd is told silver is cheaper now, yet the physical pipeline can't meet demand, that disconnect tells you the paper move did not reflect actual physical equilibrium. It reflected positioning, leverage, and forced flows. And flows can reverse faster than fundamentals. That's why I believe the next move could be violent. Not because I'm predicting a magical number, but because when a market flushes leverage out brutally, it can set up the conditions for a snapback. Shorts take profit. Weak longs are gone. Risk gets transferred to stronger balance sheets. The same machine that can push price down can also push it up when positioning flips. Algorithms don't have emotions, they have triggers. And when the trigger changes, the direction changes. Here's the part you need to understand if you got hurt on Friday. None of this is personal. The market doesn't hate you, the market uses you. If you are leveraged, you're not a participant. You are a potential source of forced liquidity. You are a candle waiting to be blown out when the wind hits. And when the system needs liquidity, it blows. Now, I want to be crystal clear about something because people love twisting words. I'm not telling you to buy. I'm not telling you to sell. I'm not telling you to go all in on anything. I'm telling you to look at the divergence that almost nobody is discussing and ask the hard questions it forces. Why did miners hold up? Why did the system tighten leverage after the damage instead of before? Why do the same types of institutions appear at critical moments? Why does the physical market often behave differently from the paper signal during stress? If you can answer those honestly, you'll start to see markets differently. Because the most dangerous thing you can do as a trader is assume the headline is the explanation. Headlines are what people repeat after the move has already happened. They are not the engine. The engine is leverage, positioning, liquidity, rules, and incentives. And Friday was not just a chart event. It was a system event. So what do I think happens next? I think the easy money on the short side has largely been taken. I think the market has been cleaned in the way these events always clean it, by wiping out the most fragile positions. I think the fear is still fresh, which is exactly when people are least prepared for a reversal. I think the physical demand pressure, whatever the exact numbers are, doesn't vanish just because a candle printed red. Solar, electronics, electrification, industrial use, those forces don't turn off overnight. Supply doesn't magically increase because price crashed on a screen. And I think the biggest tell is still that miners didn't behave like the metals crash was the start of a multi-year collapse. They behaved like the crash was a paper flush. That doesn't mean price can't go lower first. Markets can do anything. It doesn't mean there aren't risks. There are always risks. It doesn't mean manipulation is the only explanation. It rarely is. But it does mean that if you're only watching the silver chart and ignoring everything around it, you're missing the part of the story that matters. You're missing the footprint. And if you've watched markets long enough, you know footprints matter more than opinions. Now here's the uncomfortable question I want to leave you with, because it's the question that decides whether you get used by the system or you learn to navigate it. If silver's crash was primarily a leverage event, a forced liquidation event, then Friday wasn't the market discovering truth. Friday was the market extracting collateral. It was the machine doing what it does best, transferring assets from those who can't hold through volatility to those who can. And that means the real event wasn't the crash itself. The real event was what it revealed about who was forced to sell and who refused to sell. That's why the miners matter. That's why the margin changes matter. That's why delivery and positioning documents matter. That's why physical availability matters. Because all of those things show you behavior, not narratives. So if you're watching this right now and you're angry, I get it. If you're watching this and you're confused, I get it. If you're watching this and you're trying to figure out whether the market is rigged or just brutal, here's the truth. You don't need a cartoon villain for a market to function like a trap. You only need a structure where leverage exists, rules can change, and the biggest players can survive what the smallest players can't. That structure alone creates a recurring outcome. And once you see it, you can't unsee it. If this analysis helped you connect dots you couldn't quite articulate, do one thing for me. Send it to someone who got wiped out on Friday, someone who's sitting there blaming themselves, someone who thinks they were stupid, when in reality they were exposed to a mechanism they didn't fully understand. People don't need more shame. They need clarity. They need to know how these moves actually happen so they can protect themselves next time. And tell me in the comments what you noticed on Friday that didn't make sense. Did your charts show the same minor divergence? Did your broker increase requirements? Did spreads blow out? Did physical premiums in your area detach from spot? I read the comments because the crowd often spots micro signals before the mainstream ever catches up. One more thing. Don't let anybody bully you into believing you have to pick a team. You don't have to be bullish or bearish to see what's in front of you. You just have to be honest about the data. Friday wasn't normal. The divergence wasn't normal. The rule changes weren't normal. The physical stress signals weren't normal. And if something isn't normal, treating it like normal is how people get hurt twice. Stay sharp. Stay skeptical. Verify everything. And whatever you do next, make it a decision, not a reaction.